Hey everyone, welcome back. Ready for another deep dive? Today we're looking at today's market moves, and wow, it's been a wild one.
Yeah, it really has.
Geopolitical tensions, some would say straight out of a spy movie, and those earnings reports, they're giving us some serious whiplash.
Absolutely. A real roller coaster.
Buckle up, everyone, because we're going deep with this market deep dive report.
It is pretty amazing how much can get packed into a single trading day, huh? We started with news out of Ukraine that honestly had a lot of folks bracing for the worst.
Right.
And then by the closing bell, well, it felt like a whole different market. Talk about a turnaround.
Yeah, let's unpack that Ukraine situation a bit. The report, it doesn't sugarcoat things.
No, not at all.
Russia making nuclear threats, the U.S. sending long-range missiles to Ukraine. I mean, that's the kind of stuff that makes investors hit the sell button.
And you can't blame them, really. Anytime a
Yeah.
conflict even hints at going nuclear, the global markets, they kind of freak out. It's like everyone instinctively heads for what they perceive as the safest assets. You see the dollar and the Japanese yen climb almost every time there's this kind of global uncertainty. It's a pretty classic pattern.
Totally. But here's where things get really wild, and this is where you might want to take some notes if you're following along. Instead of a full-blown panic, the market, well, it kind of did a U-turn.
Right, almost like a risk-on party broke out.
Totally unexpected.
Totally. And you know what's even more interesting? When you look at what actually drove that rebound, lately it's been those cyclical sectors, your financials and industrials, leading the charge. But today, tech kind of stole the show.
Interesting. Makes you wonder if investors are seeing those mega cap tech companies as like a safe haven in all this turmoil.
I think there's something to that. Those companies, they've got huge piles of cash, right?
Bones of it, yeah.
And their businesses, they span the globe. It's almost like riding out the storm in well, a fortress made of cash.
A fortress of cash, I like that.
But it's not a perfect fortress.
Yeah.
Right? They've got their own set of challenges. I mean, think about all the regulatory and antitrust scrutiny they face.
Right, right. Okay, so maybe not an impenetrable fortress, but definitely a force to be reckoned with. Speaking of forces, we can't ignore what Walmart did today.
No, definitely not.
Their earnings report and that raised holiday forecast, it was like a shot in the arm for the market. A 3% stock price jump. That's not something to ignore, especially with everything else going on.
Absolutely. I think what we're seeing with Walmart, it's a really positive sign for the entire retail sector. It tells us that, at least for now, consumer spending, it's holding up pretty well. Could be good news for other big players like Costco and Amazon as we head into the holiday shopping season.
I see your point, but you know me, got to play devil's advocate here a bit. While Walmart's results are encouraging, are we sure the strong consumer spending will last?
That's the million-dollar question, isn't it?
Inflation's still a big concern. How long can people keep shelling out extra cash before things start to tighten up?
That's a valid point, and it's definitely something we'll be keeping a close eye on. Consumer confidence, it can shift quickly, especially when you've got these economic headwinds. So, yeah, Walmart's success is a good sign, but it's not a guarantee of smooth sailing for the entire retail sector.
Right. Okay. So retail, bit of a mixed bag there. But before we move on, we got to talk about the elephant in the room. Or maybe the chip on the motherboard, Nvidia.
Oh, yeah. Can't forget about them.
Earnings report drops tomorrow afternoon, and the anticipation, you can almost feel it.
It's understandable. They're a giant in the AI world,
Yeah.
and they've got this reputation for exceeding expectations consistently. But they also had that recent guidance miss, remember?
Oh, yeah.
Left some investors a little rattled, I think it's safe to say. So yeah, this upcoming report, especially with the transition to those new Blackwell chips, it could be the biggest market-moving event of the week. What do you think?
Absolutely. I think you're right. So we've got a potential tech resurgence, a retail sector sending mixed signals, and an AI powerhouse about to show its hand. And of course, we can't forget that wild card. All those simmering tensions in Ukraine.
Yeah, you said it. It's been a day packed with drama.
You know, it really highlights how interconnected everything is globally. Something happens halfway across the world and it ripples through every sector, impacts every investor.
Absolutely. But hey, that's what makes this also fascinating. You know, even though the market ended on a high note today, it's not all smooth sailing. Got to look a little deeper sometimes. You know what I mean? There's this thing called market breadth. And frankly, it wasn't all that impressive today.
Now, hold on. I'm all about making sure everyone listening is on the same page. What exactly does market breadth mean? Like, for someone who might not be familiar with the term.
Oh, sure, of course. Think of market breadth as a way to measure how widespread the gains are across the entire market. When it's strong, it means a lot of stocks are participating in the rally, not just a handful. But today, well, it was a bit weaker. Those gains were more concentrated in a smaller group of companies. Suggests there might be some underlying weakness even with the major indexes closing higher.
Ah, I see. So even though the overall market looked pretty good, there were still a bunch of stocks that ended the day in the red.
Exactly. And this kind of choppy market behavior, it often hints at something called sector rotation, which tends to ramp up as we get closer to the end of the year. Fund managers, they're like those chess grandmasters, always thinking a few moves ahead. They're constantly shifting their portfolios, trying to lock in gains and get ready for the next big opportunity.
Right, they're always looking for that edge.
Always. And this can create a lot of volatility as money flows in and out of different sectors.
Makes sense. So basically, we shouldn't get too carried away by a single day's gains. There are other forces at play, right?
Exactly. And that's where understanding economic data, well, it becomes really important. And wouldn't you know it, we've got some mixed signals coming in from some key indicators. Adds another layer of complexity to the whole picture.
Oh boy, mixed signals. Lay it on me. What kind of data are we talking about, and what should we be paying attention to?
All right, well, one area that's raising some red flags is the housing market. October's data on housing starts and the building permits, it came in below expectations. Could be a sign of a slowdown brewing in this crucial sector.
Housing, that's a big one. I mean, the housing market is kind of like a canary in a coal mine for the overall economy, right? If housing weakens, other industries could start to feel the pinch.
Yeah, you're not wrong about that. A slowdown in housing construction, well, it can impact everything from jobs to consumer spending, fewer homes being built, fewer jobs in construction, less demand for materials. It can create a ripple effect.
So, should we be hitting the panic button, or are there other economic indicators that might offer a glimmer of hope?
Hold your horses. There's no need to panic just yet. Remember, context is key. While the housing data is something to keep an eye on, there are other signals that suggest the economy might be a bit more resilient than we think. Take the Atlanta Fed's GDP Now indicator, for example. It's a real-time estimate of GDP growth, and it actually got a slight upward revision recently.
Okay, so a little bit of good news mixed in with the bad. It feels like we're getting pulled in opposite directions with all these different data points. How do we make sense of this? And more importantly, how does this all impact our investment decisions?
Think of it like this. You're piecing together a puzzle. Each data point, it's a little piece of the bigger picture. Our job is to analyze each piece in context, look for patterns, try to identify potential trends. One indicator I'm watching very closely is the upcoming ISM manufacturing PMI. This one's a key gauge of the health of the manufacturing sector.
Right, the manufacturing PMI. Basically, it tells us whether things are expanding or contracting, correct?
You got it. A reading above 50 signals expansion, below 50 means contraction. And, the manufacturing sector, well, it's been a bit of a weak spot for the U.S. economy lately.
Yeah, I remember from a previous deep dive that the manufacturing PMI has been struggling for a while now. Anything changing on that front?
You've got a great memory. You're right, it's been in negative territory for 7 straight months, indicating a prolonged period of contraction. Not exactly a sign of robust health, is it? But here's the thing. We've also seen some encouraging signs. For instance, the Empire State Manufacturing Index, which tracks activity in New York State, well, it just saw a pretty big jump. Could be a sign that things are starting to turn around, at least in some parts of the manufacturing sector.
Interesting. Okay, so the manufacturing picture is a little mixed, but there's at least a chance things could be looking up. But how does this all tie back to the market's performance, to what we can expect going forward? It feels like we've got all these puzzle pieces, but we're still trying to figure out how they fit together.
I love the puzzle analogy. And here's the key piece to remember. The market, it's always looking ahead, trying to anticipate what's coming next. It's not reacting to what's happening today, but to what it expects to happen tomorrow, next week, next year.
So even if we're seeing some positive signals in the data, investors might still be hesitant to go all in because of all those lingering uncertainties. The situation in Ukraine, Nvidia's earnings, the overall economic outlook. It's like they're trying to drive with one foot on the gas and the other on the brake.
Exactly. And that's why it's so important to stay informed, to learn how to analyze the data, and to understand the bigger picture. It's not about predicting the future with 100% certainty. It's about understanding the forces at play and making informed decisions based on the information we have.
This has been an incredible deep dive so far. We've navigated geopolitical turmoil, deciphered mixed economic signals, and even uncovered some reasons to be optimistic. But before we wrap things up, I want to bring this back to our listeners. What are the key takeaways here? What should they be focusing on as they process all of this information?
I think the most important takeaway is this. Even amidst all the uncertainty, all the volatility, there are always opportunities out there. But those opportunities, they often require us to dig a little deeper, to look beyond the headlines and to understand the nuances.
It's about connecting the dots, right? Seeing how global events and economic trends might impact specific companies or sectors.
Exactly. It's about asking the right questions. Like, will those mega cap companies continue to outperform in this environment? Can the retail sector maintain its momentum through the holidays? Will Nvidia's earnings report live up to the hype? These are the questions investors should be asking themselves right now. And remember, while we've covered a lot of ground today, it's always crucial to do your own research and due diligence before making any investment decisions.
Excellent advice. Thanks for that reminder.
And on that note, I think it's time to wrap up this deep dive. We've explored the latest market moves, uncovered some interesting insights, and hopefully given you a better understanding of what's shaping the financial world.
And who knows what we'll uncover in our next deep dive. Until then, happy investing.
Happy investing.